Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is the owner and CEO of Financial Resources Group. They're based out of Glastonbury, Connecticut, and they are really easy to reach. You can find them online. Thank you very much. You crack me up. I don't know what I got them all choked up over here.
Yeah.
Let me just drink something here. Boy, you got me choked up on this Saturday morning.
That's okay. I didn't even wear cologne today, Gary.
Maybe that's what it is. Maybe you need to. You can find Financial Resources Group in Glastonbury, Connecticut. You can find them online at www.frplan, FR, Financial Resources Group, plan, frplan.com. And call this phone number. As a matter of fact, you're going to want to take note of this number. Write this number down right now. I don't want you to miss the show, but at the very end of the show, I want you to call. In fact, I want you to be one of the first 5 callers at the end of the show, because there is, we'll put it this way, it's got a $2,500 value. It is a very comprehensive checklist, but it's more than that. I'll have Mark can explain it better than I can. 860-657-8380. Again, 860-657-8380. Don't worry. If you didn't get any of those points of contact, I'll repeat them at least 2 more times before the show is over. Mark, good morning. Great to see you.
Hey, good morning, Gary. It's good to be back.
Yeah, you were in Block Island? Where were you on vacation?
Well, yeah, and before I get into that, Gary, I just want to talk about the $2,500 value. That is just what it would cut my time to actually do that I'm volunteering to people who are on the show. Mm-hmm.
What is it exactly, though? I know it's a checklist. A lot of people have checklists. Yours, though, is so different.
Well, no, our idea, or what we want to do, is make sure that people have a cohesive strategy, comprehensive strategy. None of this holistic nonsense. We're talking about breaking it down, survivor's guides, making sure your power of attorney works with Social Security, making sure you always have your medical power of attorney in your back pocket. There's consequences for all these little things. Identity theft issues, taxes, unnecessary fees, hidden and unnecessary expenses that you were never shown by your advisor. Those are the things we go through. So $2,500 is a pittance compared to what the value we actually extract on even someone as small as $250,000. Now, we're really targeting people with $1 million or more. But for those people that, maybe if you're single, you just got divorced or whatever, we'll talk to people with less than that. But that's where our target market is. But we will find significantly more than that $2,500. And if I find more than that, guess what ends up happening? Is that money you had to work for, or you get to put that back in your pocket? Or you can just decide to tip the government or tip Wall Street. That's all you want.
Why would you want to do that?
Oh, some people are resistant, but that's okay. But I'm offering that at no cost or obligation for people who are members of the show. So if you listen here, come on in. You will not ever leave another meeting as whole as you will, in my opinion, as you will after you do that full checklist review.
I know,
now, it's a commitment.
True.
It's a commitment up front. But also, when I use that checklist review, we're going to weed out the people that are just poking the tires and looking for free advice because their advisor's not giving it to them. So a lot of people have an advisor. They'll come to us for those things that their advisor doesn't want to bother them with. And then they'll still want to stay with their advisor. But with the checklist, chances are you're going to, if we find enough of issues, you'll find yourself that you realize that the advisor you're working for is only working for themselves and not you. So that's exactly what we want to put your guy to the test. You might love him, might be walk on water when the market's up. Well, let's put him to the test and see. Come see me. So that's what we want to do. So anyway, that said, long-winded, I went to Newport, and I loved it. Yeah.
You take your little guy there, too?
Yeah, we went there for the 4th of July, and it's such a patriotic place. So we really enjoyed it. And the fireworks were great, and the scenery is great.
The mansions, too, and tour those? Or
we've toured the mansions before, but, I got that Mustang convertible.
Yeah, I saw it last time you were here.
We took it for a nice slow ride throughout the town and had a great time with that, just to kind of get out of, just kind of break away for a little bit. So that was a lot of fun. And then I also... aside from the big boats and all that fun stuff, the giant yachts that you can see, met a lot of really cool people. A lot of the people who stayed with at a resort were small business owners. And so it was small business owners, or I met people that worked on Wall Street or had big jobs that, young people who worked at, quantitative analysts, and just all sorts of great people. We had just so much fun, great conversations. But we also went to this place that I want to just have everybody take a look at. It's called Auxiliary Company. If you ever go to Newport, Artillery Company. It was founded in 1741 by a charter from King George II. It's the oldest continuously operating military organization under its original charter in the United States. Awesome artifacts, cannons. There was a pistol there that had a lot of historic meaning. So there's so many cool things. So we had a great time there, and it was just a wonderful time.
You go there every summer. I remember last year when you were there.
Yeah, I going back again.
I'm glad you enjoyed your trip. It sounds like you had the perfect fourth. And I understand you were trying out some other new gadgetry. Was it just the pistol, or what else were you looking at?
Well, yeah. So the pistol, by the way, was from the former leader of the Harlem Hellfighters. And it was his pistol, special pistol. He was a Medal of Honor winner.
Tell me about these Ray-Ban glasses, though, that I were they Meta glasses?
I bought the Meta. So I go to my gym, and I had so many points accumulated that I ended up with like a 30% discount off these Ray-Ban Meta glasses. So I said, why don't I try them out? Let's see what all the hubbub is all about. And I bought them, and frankly, they have a lot of technology on there that I don't want to use. I don't want to record anything. I don't want to take pictures with it. So I went there, and you could stream music and you can stream audiobooks.
Oh.
So what a perfect time for me. While I was relaxing, I streamed an awesome audiobook, and it was called Streetwise by Lloyd Blankfein, and is getting to and through Goldman Sachs. And Blankfein was not only this amazing storyteller, but just to go over his experience. Now, remember, I took over my firm. I bought my firm. I said, well, who better to listen to than the former CEO of Goldman Sachs, right?
Good choice.
And what was really interesting is some of my experience on the water company was an MDC board member, that when he was talking about the 2008 crisis, some of the crises and the crisis management skills that he had to handle things, and then having to go in front of Congress, reminded me of some of the experiences we had on MDC. So I was laughing along the whole way listening to this book. But what an incredible book. If you're in any type of leadership position or seeking to be in a leadership position, you need to do this. And this is a segue, Gary, because he also talked about risk and clients and markets. What stuck with me most was a theme that runs through today's conversation: is the discipline of managing risk before it manages you. That was one of the key takeaways from the book. Manage risk before risk manages you. It was a tremendous quote from Lloyd Blankfein, and that's a lesson every long-term investor should take to heart. And it's a nice bridge for what I really want to talk about today, Gary.
All right, well, let's cross that bridge, because we've had a sharp sell-off here, and it seems to be hitting all the names that let us hear the hardest. The chip companies, software names. Give everybody kind of a big picture here. What's really happening right now? Sure,
Gary. And this is exactly why I wanted to do the show, because some of these stocks just went completely parabolic. Everyone's chasing them. Another point that I want to make is that there's a lot of leverage in the market, a lot of borrowing, a lot of trading on borrowed money, and then a lot of leverage products. They're great on the upside, but murderous on the downside. And actually, those same type of products actually crashed the Korean markets, called the Kospi. Because of those leveraged products that people were trading, it caused a tremendous amount of volatility. I think that it dropped like 10% in a couple of days because of that. So we got to be careful of that too. But let me just give you the overall big view. If you go back to 2023, the so-called Magnificent Seven, your Facebooks, your Amazons, your Nvidias, your Microsofts, those big companies, they were the 7 biggest tech names. They surged 75.71% as a group that year, and the broader S&P returned 24.23% for that year. Those stocks, AI, ChatGPT, that whole craze, was really what saved the market in 2023. And it was a great year, but the vast majority of the gain came from just those 7 stocks. And here's the part that really stops you. If you strip the Magnificent Seven out, earnings growth for the rest of the S&P 500 that year would have actually been negative. So think about how important they were. And the other 400 plus companies, what we call the 393, collectively weren't growing earnings at all. And it wasn't just 1 year, Gary. Roll forward to 2024, the Mag 7 came in to that year roughly up 29%. Of the came in, they were the aggregate of all the market cap, 29% of the S&P 500's market value, and then climbed to an average of about 63%. They contributed 13.7% points of the index, roughly 23% gain by late December. So, in other words, the market was very, very top heavy. Way too many companies. And they had great returns, but there was just too much concentration at the top. And we saw that a while ago, Gary, and we actually started diversifying away from the Mag 7 a long time ago. 2024, 2025, we were saying this is not going to last forever, right? And that's kind of what's happening. So just the backdrop is Mag 7. Now the Mag 7 are actually struggling, but now it's all the chip stocks that went crazy. So I'll let you take
all
the
right,
floor.
so then let's talk about, well, you brought it up. I mean, I got to go there, right? Let's talk chip companies specifically. I mean, these are the darlings of the AI boom. So why are they under so much pressure all of a sudden?
Well, I mean, what happens is some of the excess is finally coming out of those names. And that unwind is exactly the reason for today's show, because if you look at a few things at once, first, valuation. Some of the leading semiconductor names were trading at pretty high. Not all of them, by the way. Like for example, Micron was trading at all-time low multiples, forward-looking multiples. Rear looking high, but forward looking low because the demand is so crazy. But multiples that are pricely near. But they're also, all these stocks are priced what they call price to perfection, meaning that they're trading at high multiples, high PEs, and God forbid you got one little glitch in their earnings report or one little nick on the revenue, or their forward guidance isn't what Wall Street was expected, and they just get slammed. IBM was a totally different example, dropped 25% in a week. That was on hardware sales. But my point is, you can see when the markets get lofty, it doesn't take much to pop the bubble. So when a stock is priced for perfection, it doesn't take much of a disappointment trigger to move it down. So second, AI capital spending, that story is starting to get questioned, and investors are asking whether the enormous data center build out is sustainable and whether the return on all that spending justifies prices. And third, the simple mechanics of a crowded trade. When everyone owns the same handful of names and sentiment turns, then the exits get very, very narrow.
All right, so it's not the technology that's bad. It's that the price kind of got ahead of the reality.
The price is getting ahead of reality. We're building these massive data centers. Musk wants to go to space with them, which he thinks he can do better, cheaper, faster. I would be most concerned about the Chinese dumping their AI in our market and companies using their AI, because the tokens are getting very expensive here. And if the Chinese disrupt our AI, disrupts our AI, all this capital spending, this $1 trillion of spending that we're seeing on these data centers goes away. No one's going to need it. So you have to be very, very cautious. You have to be very, very watchful eye on that whole situation.
I mean, you mentioned software names that are struggling too, and that kind of surprises some people. Isn't software supposed to be, the high margin recurring revenue part of tech?
Well, it used to be. The big problem right now is here's the perfect example is Microsoft. Microsoft has, the very strong revenues, great recurring revenues, strong free cash flow. But that free cash flow now for a lot of these companies, Oracle, Microsoft, Meta, that used to be the darlings of Wall Street, is now being put towards, data centers. They're also issuing stocks, so that cash is going into the data center build out or the compute build as hyperscalers. Now that's money, Gary, that they're not using to buy back their stock. That's not money that they're using for other purposes. And that's actually making it, a little bit less attractive, and the companies are looking less profitable. Now, the other problem with that is, and I didn't really, decide to I'll talk about that, is a lot of their debt was created off balance sheet, and a lot of their debt was funded by private equity and private lending entities and special purpose vehicles, and it doesn't show up on their books. So that's a whole other animal that you have to kind of roll up when evaluating these companies. Now, long term, will they be great? Yes. But short run, they are massive mega companies, and they're stretching their budgets as if they were startups all over again. That's the way I'm looking at it.
So,
and all the founders are startup founders. These guys remember when they're eating, ramen noodles at 3 a.m. while they were coding, but now they're worth, $50-60 billion. But that, I don't think that spirit's left them, and they're stretching their neck as far as they can on this stuff.
So the same force, AI, that lifted the chip makers, they're now casting a shadow over parts of the of software, if you think about it.
Well, yeah. So Claude has disrupted a lot of the software for service, open source models that you saw. If you've ever been down to the SAS Institute in North Carolina, it's in Raleigh. It is a massive campus. There's a beautiful 5-star hotel there. And everybody was just, I went down there, it's like probably about 6 years ago. I mean, everyone was giddy because you had the cloud, build out. You had this software for service, and now they call it the SaaSpocalypse because what's happening is Claude can now code. Claude can do lots of different things through Anthropic that can very easily disrupt those softwares. So, even Salesforce, which is a darling of a software company, is all, these stocks are all down well off their highs. So they're reinventing themselves. They're going to be disrupted if they don't reinvent. And the companies that do reinvest in themselves and do invest in that capital expenditure are going to be fine. The ones that are not, obviously are going to just disappear. So there's a massive amount of disruption happening as a result of AI right now.
Folks, you are listening to On the Mark, along with Mark Papa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group. They're out of Glastonbury, Connecticut. You can find them online, www.frplan.com. More importantly, this is the number I want you to call very shortly, actually, in about 10 minutes. So you can be one of the first 5 callers, and you'll receive one of those comprehensive checklists. We were talking about at the beginning of the show. It's valued at $2,500. Quite frankly, I think it's valued at even more than that. But it's and it's when I say comprehensive, I don't mean that lightly. I mean it covers everything, and you'll know right when you sit down and talk with Mark. 860-657-8380. 860-657-8380. So, Mark, let's get to what you really call the story of the show. The rotation, because money is leaving tech. So where's it going?
Well, basically, it's just like anything. For example, with the chip makers, hot trade, let's buy the stocks, let's buy this, let's buy that. And then people chase that up, and then, the greater fool buys that last share, and then the market sells off, right? So we want to make sure, I think what we're seeing here, because we don't chase themes, is what we want to talk about is the great rotation, the rotation that we're seeing again. When we saw this, Gary, at the beginning of the year too, and then it went away, and then the technology trade came back, and now all of a sudden it's shifting away again. What's happening? We also have potentially rising interest rates. By the end of September, we make it a rate hike. We're starting to see more inflation. So markets, growth companies, and inflation, growth companies, rising interest rates does not bode well for many growth companies. It's just the way it's always been, and it's just true. So you're looking at financials, industrials, and those type of companies that are starting to benefit. And we need to have a broadening out, Gary. It's very healthy for the market. And for 2 years, the market was a barbell balanced almost entirely on one end. What's happening now is the capital is rotating to parts of the market that were left behind. Like I mentioned, financials, industrials, healthcare, energy. I think energy is going to be enormous. Going forward. Consumer staples, those are areas that just get forgotten. They get undervalued. So people are going to take profits, and they need to park their money somewhere. So you're going to take an overvalued company, sell it, take a profit, and you're going to put it in a sector that's undervalued. So I think that's extremely important. The best trade you can make as an investor, and this is what we profess at our firm. What am I trading today? I'm trading this diversification trade, being diversified. Truly diversified, not Jim Cramer diversified, where I own 5 different stocks in 4 different sectors. We're talking truly diversified, so we can always talk about that too.
I mean, you talk about equal weight, quality, value; those are all significant.
Yes, these are the factors that we definitely are very focused on. One of them is equal weight, a quality factor with an equal weight overlay, meaning our index is equally weighted. So if we have 30 stocks, each one's going to have 33 1/3% ownership to equal 100. And a traditional S&P index fund is weighted by size, so the biggest tech names dominate it. I've never liked that strategy. I've always diversified away from it, whether it was an equal weight strategy or an earnings weighted strategy. We felt that smoothing out the ride and getting more of those companies who are coming up the ranks, a bigger piece of that pie is better for our long-term returns and long-term potential outcome. So we did that. An equal weight version of the same S&P companies gives every company the same slice. So when leadership broadens out beyond the mega caps, equal weight tends to shine, and it has. It's benefited us greatly. and because you're no longer betting the farm on a handful of stocks. Now, if you're a Vanguard investor or BlackRock investor and you own the VOO or the SPY, and yeah, in a good year like we had in 2023 and 24, you're pumping up your chest, you're sticking your chest out like I'm beating the market, I'm beating the average advisor. Well, you're not anymore, right? And because those stocks are no longer dominating, so things are starting to broaden out a bit. And our model actually, I can't quote the numbers because don't want to get in trouble with the SEC, but we are trending and still trending ahead of the S&P.
All right,
and
so
we're happy about that.
Instead of guessing which single stock is next, you're actually tilting the whole portfolio toward those characteristics, right?
Yeah, so there'll be an equal weight strategy on the index, so how the index is constructed for some of them. And then there's a quality factor. These are companies with strong balance sheets, consistent earnings, high returns on capital, and low debt. And in a market that's suddenly worried about durability of earnings, quality is a flight to safety trade that keeps you invested in stocks. So we have a good slice of our large cap. I mean, we're always looking for quality, but a good slice of our large cap and a good part of most of our overseas exposure. It's a dividend weighted strategy, but yes, and it's also currency weighted. We have that. We make sure that is that's covered. And then there's also value. I mean, these are stocks that are trading at reasonable prices relative to their earnings and assets, and value spent years being unloved while growth ran away. But the expensive end of when the market corrects, the reasonably priced end is the resilience, where the resilience shows up, and equal weight, quality, and value. These three factors are very helpful. And a third strategy has been momentum, mid-cap momentum strategy, where done very, very well for us. Recently kind of suffering because struggling, but still up for the year dramatically. But, we like momentum as well. I think we like to balance it out. We don't want to take on any one theme.
All right, so let's bring in the economy, because none of this happens in a vacuum. And we just got the June inflation data. What did it tell you? I mean, what does it mean for the Fed here?
Well, the June report was very encouraging. But however, I feel it was a head fake as well. A lot of these numbers get revised from time to time. Now, we were going to make peace with the Iranians. Now we're not making peace. Oil's back up above, 90 a barrel. This number is, I don't know how long it's going to stick around. Let's put it that way. But it's so basically, though, so if you look at what the Bureau of Labor Statistics said, headline inflation, the number most people actually feel, slowed to 3.5% over the past 12 months, down from 4.2 in May. And a month-to-month prices actually fell 0.4%, the largest monthly decline since April of 2020. So on the face of it, it was a real break for consumers.
It sounds good. I mean, I like what you just said. Does that mean that the Fed can finally start cutting rates? Because you just said something a moment ago. You anticipate them going up in it in September.
Yeah, and here's where you have to read past all the headlines. Is almost all the improvement came from one place. That was energy prices. So the energy index fell 5.7% for the month, with gasoline down 9.7%. But that's a welcome break at the pump. But energy is the most volatile, geopolitically driven part of the basket. And we know that things are not moving a lot slower than expected in Iran. So that's tied directly to overseas risks that, we'll get to in a minute. But the relief could be proved to be temporary. Now, you strip out food and energy, and that's what economists call core inflation. And the picture is stickier. Core was flat for the month, so not as good as that number looked. It's still running at 2.6% over the past year, above the Fed's 2% target, and food is still up 3% year over year. So that hits every family's grocery bill. So the Fed can't really declare victory anytime soon.
So then, what does that mean as far as what the Fed does next?
Well, my read is, and we've been saying this for quite some time, and our partners at Astoria Investments now. Have been saying it since 2021, 22, when we started getting lots of inflation. It's going to be higher for longer. Rates are going to be higher for longer. Inflation is going to be stickier for longer. Very hard to put the genie back in the bottle. And my feeling is there's really only one way to correct that, because if you look across the globe, we're in a rate increasing cycle, not a cut, not a decreasing cycle. It's a rising rate environment across the globe. I think that, unfortunately, the only way is up on this one.
And for, higher for longer rates, how does that connect back to the sell-off in tech?
Well, I mean, higher interest rates don't bode well for companies that have to borrow to grow. And it takes capital out of the market. It takes liquidity out of the market. That's the entire idea of it. Excess liquidity is what causes inflation. Too many dollars chasing too few goods. So I can ultimately see why that may have to be the case. Now, hopefully they don't have to smash the economy to pieces and cause a recession. But unfortunately, they do have to get the gears to grind a little bit to slow things down.
All right, final question because I'm running out of time, and this is what I think want listeners to hear, because this is really the one thing that, to describe what's happening, and another to have acted on it ahead of time. How do you position portfolios last quarter to take advantage of this rotation and protect clients from, the tech volatility?
Well, what we did is, you have to trim back your concentrated technology exposure, and we did that in April. We made sure that we double checked our tech exposure to make sure it wasn't too much. Mm-hmm. So we were happy with where it was, so we left it alone. But if you look at the overlays and the different things that we have, technology was still somewhat a piece of our portfolio, but we didn't get hurt too badly because of the quality and the equal weight overlays. Mm. So we didn't really feel a big. Put it this way, we're down from our peak, but we're not. We don't have any losses for the year, and we didn't fall anywhere near as much as the market did earlier in the year in April, and we're still ahead of the S&P. So I can't really complain in how we built our models. We did make some changes. We made sure that we had a dynamic hedge on our overseas investments, meaning that on our core overseas investments, both sides of the currency, the strong dollar, weak dollar, are both hedged. So that was important. Before, we were only dollar hedged on the downside. So we did that. We bought into international markets. That was a free, another product. So, we bought emerging markets as well.
All right. Can you do a quick disclaimer? Because then I got to wrap it up.
Yeah. The opinions expressed during this program are those of Mark Papa personally and do not necessarily reflect the views or positions of Financial Resources Group, LLC. All investments involve risk, including a loss of potential, loss of principal. Nothing discussed in this program constitutes an offer to buy or sell any security or investment product. Past performance is not indicative of future results, and Financial Resources Group, LLC is a state-registered investment advisor. Always consult with a qualified financial professional before making any investment.
All right, right now is that time for you to call. Be one of the first 5 callers right now. 860-657-8380. You'll receive that consultation and checklist. It's so comprehensive. Minimum $2,500 value. Yours free. One of the first 5 callers right now. 860-657-8380. Financial Resources Group out of Glastonbury and online at frplan.com. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.